This is Japanese Economic Review Channel. This time, let's take a look at SBI Securities' domestic weekly outlook.
Glad to be here for this one. There is a lot to unpack.
There really is. I mean, right now, if you look at the global landscape, it's kind of a mess, right? Markets are bracing for stagflation. The Middle East is just on this geopolitical knife edge. And
Those aggressive U.S. rate cuts everyone was banking on.
exactly, they're just suddenly vanishing, replaced by, murmurs of actual rate hikes.
Which is a huge pivot.
Right. So by all traditional logic, the Japanese market should just be buckling under this pressure. But instead, it's stubbornly holding its ground. So today, for everyone listening, we're going to find out why.
Yeah, we really need to cut through the global noise for you.
We do. We've got SBI Securities' comprehensive roadmap for the upcoming trading week. And our mission in this deep dive is to show you not just what the numbers are, but the underlying mechanics of why they're moving. We want to give you absolute clarity for your portfolio.
And I'd say it is a critical week to be paying attention. We're looking at this really complex web of data points colliding with, well, shifting geopolitical fault lines.
Right. It's a lot to take in.
It is.
Yeah.
But to really understand what's happening, we have to look through a very specific lens. This entire week is governed by one underlying theme, and that's liquidity risk.
Liquidity risk. Okay. Break that down for us.
Think of market liquidity like water in a river. Normally you have this deep, wide flow of buyers and sellers.
Right.
But as we head toward the end of this week, that river is going to dry up significantly because of global holidays.
Oh, wow.
Yeah.
Mm.
So every piece of news, every data point is going to act like a boulder dropped into a really shallow stream. The splash is just going to be much more violent.
I love that mental model, the drying river. Let's keep that in mind as we look at the baseline numbers for the domestic stock market.
Let's do it.
So right now, the Nikkei average is sitting at 53,373.07, and the TOPIX is at 306.49.69.
Right.
And the forecasted Nikkei range for the week is between 50,500 and 54,500 yen.
Which is a pretty significant band.
It is. And the critical floor, like the support level that technical traders are hyper-focused on right now, is that recent intraday low of 50,688.
And honestly, those levels tell a fascinating story of resilience. When you look at the macro environment, the Japanese market is essentially climbing a massive wall of worry.
Yeah, that's a good way to put it.
It's absorbing a staggering amount of negative pressure without breaking that 50,688 floor.
Well, let's talk about the bricks in that wall because it's looking pretty formidable.
It really is.
We mentioned stagflation fears, which is that nightmare scenario where economic growth stalls but inflation stays high, so central banks are just trapped.
Exactly.
We also have these brewing issues in U.S. private credit, and on top of all that, we're hearing whispers of an AI bubble bursting.
Which is terrifying for some.
Oh, absolutely. If you're holding tech-heavy Japanese equities, that AI whisper is just, well, it's terrifying.
Let's actually pull the thread on that U.S. private credit issue for a second, because I think it explains a lot of the underlying anxiety.
Sure, go for it.
During the era of zero interest rates, a massive amount of corporate borrowing moved away from traditional banks and into private credit markets.
Right, because money was basically free.
Exactly. But now that U.S. rates are staying higher for longer, the interest payments on that floating rate debt are just skyrocketing.
Oh, right.
So defaults are starting to rise. And if that market cracks, the contagion easily reaches Japanese financial institutions that have exposure to those overseas loans. It's like a slow-moving storm.
But even with that storm brewing, it seems like the market is entirely hijacked by the geopolitical landscape right now.
Completely.
I mean, we're strictly looking at the market reaction here, but the standoff in the Middle East is basically the heaviest anchor on the market right now.
It is the ultimate wild card. You have the U.S. administration actively seeking a diplomatic end to the conflict, right?
Yeah.
While Iran maintains a very firm grip on energy supplies, specifically the flow of oil through the Strait of Hormuz.
Which is a massive choke point.
Right. Control of that strait directly impacts global energy prices. If oil spikes, inflation spikes. If inflation spikes, central banks cannot cut rates. The entire macroeconomic playbook just gets thrown out the window.
And you can see the market desperately trying to price in a timeline for that.
Oh, yeah. They're obsessing over it.
According to the SBI Outlook, there was an expectation of military attacks on power plants, but those have been explicitly postponed to April 6th.
Right.
which lands on the morning of April 7th, Japan Standard Time. And at the exact same time, there's massive diplomatic maneuvering happening.
Yeah, the schedule is
A
packed.
rescheduled U.S. diplomatic visit to China is set for May 14th and 15th, and traders are aligning that with a rumored April 9th target to officially end the conflict.
The market is starving for certainty, so it's latching on to these specific dates. This brings us back to the resilience of the Japanese market.
How so?
Well, despite the private credit risks, the AI bubble fears, and the threat to the Strait of Hormuz, Japanese stocks are holding above their year-end levels.
And this is exactly what I want to challenge you on.
Okay, let's hear it.
To me, the Japanese market right now looks like a pressure cooker. It's absorbing all this intense heat. Plus, add in the ex-dividend dates hitting on the 30th, which naturally puts downward pressure on stock prices, right?
Sure.
And yet it just stubbornly refuses to blow its lid. So are institutional investors just burying their heads in the sand, or is there a structural strength here that I'm completely missing?
It's definitely not ignorance. It's actually a phenomenon known as verbal intervention fatigue.
Verbal intervention fatigue.
Yes. For weeks, institutional investors have been reacting to political rhetoric, rumors, diplomatic threats. They were selling off on every aggressive headline.
Right, just constant whiplash.
Exactly. But you eventually reach a saturation point.
Yeah.
The market refuses to panic sell based purely on words anymore.
Ah, I see.
It's waiting for tangible, factual progress, like either a signed ceasefire or an actual physical escalation. Until one of those happens, big money is simply sitting on its hands.
So they've essentially built up an immunity to the headlines.
Exactly.
But if they're sitting on their hands in the stock market, where is all that anxiety actually showing up?
It is spilling directly into the foreign exchange market. If you want to see the real-time fear gauge of the global economy, you have to look at the tug-of-war in the USD-JPY exchange rate.
Which brings us perfectly into the currency dynamics for the week.
Yes.
The expected range for the USD-JPY is 157.00 to 161.00. And the SBI report specifically notes that 157 represents the 13-week moving average.
That's a crucial baseline.
Just to ground that for a second for you listening, a 13-week average roughly covers the last business quarter, so it acts as a very strong baseline for medium-term trends.
Right.
If it breaks below 157, the trend is shifting. But right now, we are nowhere near that floor.
We aren't, because technical baselines like that 13-week average are currently fighting a losing battle against geopolitical headlines.
Yeah, technicals don't matter as much right now.
Exactly. The yen's movements are being dictated almost entirely by the situation with Iran rather than any traditional economic fundamentals.
And we literally just saw this play out, didn't we?
Oh, absolutely.
When those military attacks on the power plants were delayed, the dollar immediately weakened. The whole risk-off panic just reversed.
Right.
But the second that ceasefire talks were denied in the press, the dollar surged right back up on safe haven buying. To me, it looks like a bidding war for a safe room.
Yeah.
The moment peace looks unlikely, investors just hoard U.S. dollars.
That is a very accurate way to describe it. And this standoff, the U.S. looking for an exit strategy while Iran maintains a hardline stance to keep oil prices high, it creates a very specific threshold for the currency pair.
Which is?
If this holding pattern of delayed actions and denied talks continues, the pair seems firmly capped at the 160 level. The market won't push it past 160 without a fresh catalyst.
But let me push back on the logic there for a second. If the U.S. is facing this potential stagflation, and we're talking about inflation-driven rate hikes, shouldn't the dollar be moving based on the fact that U.S. debt is getting more expensive?
You would think so.
Right. Like, why is the market completely tossing out the traditional economic playbook to only watch the Middle East?
It comes down to the hierarchy of market fears.
Hierarchy of fears.
Yeah, you have to think about capital preservation as the primal instinct of the market. In the short term, a geopolitical safe haven panic will always override long-term macroeconomic data.
Wow, okay.
If a conflict threatens to choke off global energy supplies, investors do not care about U.S. private credit defaults. They just buy the world's reserve currency, the dollar, to survive the immediate shock.
So the macro data doesn't matter anymore?
No, it absolutely matters, and that is the danger here. The economic data hasn't vanished. It's just quietly piling up in the background, building immense pressure.
Oh, I see where you're going with this.
The moment the geopolitical noise subsides, like the moment we get that tangible ceasefire, all of that built-up macroeconomic pressure is going to release at once.
And if that pressure releases and pushes the dollar past that 160 cap, we're in a completely different paradigm.
Entirely.
Because if it blows past 160, it drastically increases the risk of market intervention by the Japanese government and the Bank of Japan.
Yes.
They would have to step in and physically buy in to stop the bleeding, which sends shockwaves through every asset class.
Exactly. And this is where we have to connect the currency standoff back to our drying river metaphor from earlier.
Right, the liquidity risk.
Because while the market is fixated on the Middle East, the actual economic calendar for this week is incredibly dense. We have major data points acting as boulders, ready to be dropped into a market where liquidity is about to vanish.
So let's map out that river day by day, because the weekly timetable here isn't just a dry list of events.
No, it's really not.
It's basically a suspenseful countdown. Starting on Monday, March 30th, the main event is the Bank of Japan releasing the summary of opinions from their March monetary policy meeting.
Which is a really crucial document.
Why is that?
Well, it isn't a new policy decision. Rather, it's the transcript of the internal debate. It shows us the dividing lines among the BOJ board members regarding their next steps on interest rates.
Oh, okay.
If the summary reveals that more members are worried about inflation than previously thought, you'll see immediate movement in Japanese government bond yields.
Okay, so that's Monday. Then we roll into Tuesday, March 31st, which is just an absolute data dump.
It's massive.
It's heavy on both domestic and international fronts.
Mm.
Domestically, right at 8:30 a.m., we get the March Tokyo CPI, February unemployment, and the jobs to applicants ratio.
Yeah.
Shortly after, industrial production data hits. We also have a 2-year JGB, or Japanese government bond, auction. And French President Macron arrives for a visit lasting until April 2nd.
Let's isolate the Tokyo CPI for a moment there.
Yep.
The Consumer Price Index for Tokyo is essentially the crystal ball for the national inflation rate. It comes out weeks before the nationwide data.
So it's a leading indicator.
Exactly. If Tokyo CPI comes in hotter than expected, it adds immediate fuel to the idea that the BOJ will have to raise rates sooner rather than later.
Makes sense. But looking at the sources for Tuesday, I actually noticed something wild buried in the schedule.
Oh, yeah?
Yeah. Amidst all these heavy economic indicators, Tuesday marks a massive cultural milestone.
Right, the telecom news.
Yes, NTT Docomo is officially ending its 3G FOMA and iMode services. And on the exact same day, the physical paper town page phone book is dead. Plus, the 104 directory assistance service is shutting down for good.
It is a profound technological changing of the guard.
It really is. It's like closing a time capsule. We're burying the flip phone and the paper phone book on the exact same day that we are actively stressing out about the valuations of generative AI companies.
It's a crazy juxtaposition.
And globally on Tuesday, it doesn't let up. We have China's PMIs coming out, which tells us if their manufacturing sector is expanding or contracting.
Super important.
We get U.S. house price indices and the U.S. Conference Board consumer confidence numbers. Oh, and plus, the Indian market is completely closed.
Tuesday definitely sets the table. But Wednesday, April 1st, is where the macroeconomic reality really starts fighting back against the geopolitical headlines.
Okay, what happens Wednesday?
Just before 9:00 a.m., we get the BOJ Tankin survey.
Now, I always hear the Tankin mentioned as a heavyweight indicator. But for you listening, trying to gauge its actual impact on your portfolio, what makes this specific survey so vital?
Well, the Tankin isn't just a generic sentiment poll.
Mm-hmm.
It's the BOJ's direct thermometer for corporate confidence.
Okay.
It surveys thousands of Japanese companies from massive conglomerates down to medium-sized enterprises. And it tells us point blank if these companies are planning to spend cash on capital expenditures or if they're hoarding it out of fear. If the big manufacturers are pessimistic, it means corporate growth is going to slow down, and that directly hits stock valuations.
Okay, so we get the unvarnished truth from Japanese corporations on Wednesday morning. Then later that day, we get Eurozone unemployment, the U.S. ADP employment report, and the U.S. ISM manufacturing index.
You need to pay very close attention to that U.S. ADP employment report.
Why that one specifically?
It measures private sector job growth in the U.S., and it serves as the precursor to the official government jobs report on Friday. If ADP shows that the U.S. labor market is still running incredibly hot, it completely kills any remaining hope for imminent U.S. rate cuts.
Wow. Okay, so that leads us directly to Thursday, April 2nd. We have the monetary-based data and a 10-year JGB auction. Why is a bond option so critical this week?
Because of everything we just discussed regarding inflation and the BOJ, an auction tests the market's actual appetite for government debt.
Right.
If the auction goes poorly, meaning there aren't enough buyers for those 10-year bonds, yields will violently spike.
Yeah.
And a spike in yields puts immediate pressure on the BOJ and can trigger a sell-off in the broader equity market.
Also on Thursday, we have the IPO for Vitarbridge Japan, which is a great real-time test for retail investor sentiment.
Exactly.
If an IPO can't find traction in this environment, it tells you that domestic retail buyers are getting defensive. We also get the U.S. trade balance. And importantly, Israel's market is closed on Thursday.
Right.
Which brings us to the grand finale, Friday, April 3rd.
Friday is the collision point.
Yeah.
This is where the boulder drops into the river. We have the massive U.S. March employment statistics.
And the context here is key.
It is. Everyone is on edge because February's report showed a shock drop of 92,000 in non-farm payrolls. The market is desperate to know if that was a blip or the start of a severe U.S. labor market contraction.
Right. We also have the U.S. ISM non-manufacturing index on Friday. But there is a massive structural catch to this specific Friday, isn't there?
Yes, there is.
And this is where your liquidity risk metaphor comes full circle. Friday is Good Friday. Markets in the U.S., Europe, and across much of Asia are closed.
Completely shut down.
Furthermore, the SBI Outlook specifically warns that the U.S. economic data itself could face reporting delays due to the lingering impacts of past government shutdowns.
Yeah, that's a huge wild card.
So let me ask you, with global markets effectively shut down on Friday and the risk of the data being delayed anyway, won't Wednesday's BOJ Tankin and US ADP data actually become the functional finale of the trading week for most big players?
For institutional money, yes, absolutely. Wednesday acts as their psychological finale.
Interesting.
They do not want to hold massive unhedged positions going into a long weekend loaded with geopolitical risk and volatile jobs data. They'll just close their positions early, and that is exactly what dries up the river.
So if a retail investor is actively trading on Thursday or Friday, they are wading into very dangerous, shallow waters.
Incredibly dangerous. Let's say a piece of news breaks on late Thursday or Friday, whether it's a delayed U.S. jobs print that surprises the market or a sudden, unexpected geopolitical escalation in the Middle East.
Yeah.
Because the big institutions have already stepped away, there are very few buyers and sellers left to absorb the shock of that news.
The boulder hits the shallow stream, and the splash is enormous.
Precisely. Without deep liquidity, prices don't just move, they gap violently. A minor sell-off can trigger an avalanche of automated stop-loss orders because there's just no one on the other side of the trade to catch the falling knife. It is a textbook liquidity trap.
Okay, let's synthesize all of this. Our goal was to give you, the listener, absolute clarity for your portfolio this week amidst all this noise. The core takeaways from the SBI Outlook are clear. First, keep a very close eye on that 160 yen intervention line that is your invisible boundary for currency shockwaves.
Yes.
Second, you have to filter out the verbal interventions, ignore the political rhetoric, and look strictly for tangible, factual progress on a ceasefire to gauge where the market is actually heading.
And critically, manage your exposure. The macroeconomic data is fiercely fighting the geopolitical fear, and the holiday schedule is amplifying the tension between the two. Do not get caught navigating shallow waters when a macro boulder drops.
Exactly. Brace your portfolio for a highly volatile, liquidity-thinned end to the week. Now, before we go, we want to leave you with a broader thought to mull over, inspired by Tuesday's data dump.
Yeah, the tech graveyard.
Right. We noted that foundational technologies like the 3G network and the paper phone book are officially retiring this week, right at the exact moment the market is anxiously trying to price in the future of artificial intelligence.
It's quite the contrast.
It makes you wonder, what invisible foundational systems are we relying on today in our portfolios that might quietly become completely obsolete by the next market cycle?
That's a question worth asking.
Thank you for watching the Japanese Economic Review. We look forward to having you with us again.